The Federal Reserve and its origins. Once upon a time, in the late 19th century, the United States found itself in a financial wilderness. The country was growing rapidly, its cities expanding, its industries booming, and its people hopeful for a future of prosperity. But despite this economic vigor, the nation's banking system was fragile. The economy was prone to booms and busts, and the country experienced frequent financial panics, moments when banks failed, businesses collapsed, and ordinary people lost their savings. In these times of crisis, the nation seemed to have no reliable way to stabilize the economy or manage its currency. The most notable of these crises was the Panic of 1907. This financial disaster saw a widespread bank run, where terrified depositors rushed to withdraw their money, fearing their banks would collapse. Many banks did fail, and the stock market crashed. The federal government, at the time, had no real way of intervening to stop the panic from spiraling out of control. The nation's banking system was decentralized and unregulated, with hundreds of private banks, each operating independently, making it difficult to ensure stability or maintain confidence in the currency. During this time, a man named J.P. Morgan, one of the wealthiest bankers in America, took it upon himself to calm the storm. Morgan used his immense wealth to rescue failing banks and stabilize the financial system. While he was hailed as a hero by some, others saw this as an unfair concentration of power in the hands of one man, a reminder of how fragile and inequitable the system had become. This moment of crisis led to a growing realization: the United States needed a central institution capable of managing the country's money supply, controlling inflation, and acting as a lender of last resort in times of economic distress. The call for reform grew louder. In 1913, President Woodrow Wilson responded to these concerns by signing the Federal Reserve Act into law. The Federal Reserve, or the Fed, as it came to be known, was designed to be a central bank with the ability to regulate and stabilize the financial system. Unlike the centralized Bank of England, which had been established centuries earlier, the Federal Reserve was created with a delicate balance. It was designed to represent both the needs of the federal government and those of private banks, ensuring the system would be more democratic and decentralized than its European counterparts. The Federal Reserve Act created a system with 12 regional reserve banks across the country. Each bank was intended to serve its region's needs while also working together under the guidance of the Federal Reserve Board, which was based in Washington, D.C. This structure was meant to ensure that no single region or set of financial interests would dominate the system. The Federal Reserve was given the authority to issue currency, regulate the money supply, and set interest rates. It could also step in to lend money to banks in need, helping to prevent the sort of panic that had occurred in 1907. In essence, the Fed was tasked with ensuring the stability of the financial system and the broader economy, both in times of prosperity and during times of crisis. However, the creation of the Federal Reserve did not end debate. Some critics argued that it gave too much power to bankers, while others feared it might become a tool of political influence. The public, though, recognized the need for a stabilizing force in the economy, and over time, the Federal Reserve became a central figure in American financial life. Over the decades, the Fed's role evolved. During the Great Depression in the 1930s, the Federal Reserve's actions, or lack thereof, were scrutinized, leading to changes in its structure and powers. After World War II, the Fed became a key player in managing post-war inflation and supporting global economic recovery. In the latter half of the 20th century, it adjusted interest rates and used monetary policy to combat inflation, recession, and unemployment. Today, the Federal Reserve remains one of the most powerful and influential institutions in the world. Its decisions can impact everything from mortgage rates to the value of the US dollar. It has faced criticism, particularly during times of economic inequality or financial crises, but its role as a stabilizing force in the US economy is undeniable. The origins of the Federal Reserve are a tale of crisis, reform, and compromise, born out of the lessons learned from financial chaos and the understanding that in a complex, interconnected economy, stability and trust in the system are paramount. What began as a response to the challenges of the early 20th century continues to shape the American economy to this day. And so, from the ashes of past panics, the Federal Reserve stands as a testament to the nation's ongoing pursuit of financial stability, with an ever-watchful eye on the health of the economy for generations to come. As the years passed, the Federal Reserve continued to evolve, its influence growing with each new economic challenge. In the 1970s, it faced a test unlike any before: stagflation. The U.S. economy was simultaneously experiencing high inflation and rising unemployment, a rare and troubling combination. The Fed's ability to control inflation without stifling growth was put to the ultimate test. Under the leadership of Paul Volcker, who became chairman of the Federal Reserve in 1979, the Fed took dramatic steps to curb inflation. Volcker raised interest rates to historically high levels, which led to a sharp recession in the early 1980s. Many Americans felt the pain of rising unemployment and mortgage rates, but Volcker's strategy succeeded in bringing inflation under control. This bold and sometimes controversial decision cemented the Federal Reserve's role as the country's chief economic stabilizer, willing to take difficult actions to ensure long-term prosperity. In the following decades, the global economy became more interconnected, and the Fed's role began to extend beyond U.S. borders. The collapse of the Soviet Union, the rise of China, and the growth of international trade led to a new set of challenges. In the 1990s, the United States experienced an economic boom, marked by rapid growth in technology and the stock market. The Fed, under Chairman Alan Greenspan, kept a close watch on inflation and economic bubbles. The dot-com bubble of the late 1990s and early 2000s tested the Fed's ability to manage the effects of speculative markets. But it was the financial crisis of 2007-2008 that truly transformed the Fed's role in the modern era. The crisis, triggered by the collapse of the housing market and the failure of major financial institutions, plunged the U.S. and the world into the worst recession since the Great Depression. Banks stopped lending, credit markets froze, and millions lost their jobs and homes. The Federal Reserve, led by Chairman Ben Bernanke, became the epicenter of the response to the crisis. In a series of unprecedented moves, the Fed slashed interest rates to near zero and launched a program of quantitative easing, in which it purchased trillions of dollars worth of government and private debt to inject liquidity into the financial system. These measures were controversial, with critics arguing that they disproportionately benefited large banks and investors, while others feared they would lead to inflation down the road. Nevertheless, the actions of the Fed helped to stabilize the financial system, prevent further collapse, and set the stage for a slow economic recovery. The crisis of 2008 also raised questions about the oversight and accountability of the Federal Reserve. As its powers expanded, so too did the scrutiny it faced. The Fed became a focal point in debates over economic inequality, with many arguing that its policies had contributed to the growing wealth gap. The public's trust in the Fed's ability to balance the interests of Wall Street with the needs of Main Street was tested. In the aftermath of the Great Recession, the Federal Reserve's role continued to shift. It not only focused on stabilizing the financial system but also became increasingly involved in issues of financial regulation and ensuring that the economy could grow in a sustainable and inclusive way. The Dodd-Frank Act of 2010, a response to the financial crisis, brought new regulations aimed at preventing another meltdown. The Fed was tasked with overseeing many of these new rules, further expanding its mandate. As the 21st century progressed, new challenges arose. The rise of digital currencies, the growing complexity of global financial markets, and the looming threat of climate change all demanded the Fed's attention. Critics of the Fed's policies continued to argue about its influence on income inequality, while others questioned its role in a rapidly changing global economy. Through it all, the Federal Reserve remained a symbol of the nation's effort to balance economic growth, stability, and fairness. It was a reminder that economic systems, like human societies, are always in a state of change, subject to the forces of innovation, crisis, and reform. And so, the story of the Federal Reserve, born from the lessons of financial panic and the desire for stability, continues to unfold. Its complex and sometimes controversial actions have shaped the course of American economic history and will undoubtedly continue to play a pivotal role in shaping the future. Whether in times of crisis or calm, the Fed remains a central force in the ongoing evolution of the U.S. economy, an institution that constantly grapples with the balance of power, trust, and the ever-present pursuit of economic prosperity. As the world faces new challenges in the years ahead, the Federal Reserve will likely continue to adapt, its story written not just in the decisions of policymakers but in the broader arcs of history, from the Industrial Revolution to the rise of the digital age. Its origins were in the lessons of the past, but its future will be written in the choices it makes as it navigates the complex terrain of tomorrow's global economy. As the 21st century unfolded, the Federal Reserve faced even more dynamic and interconnected challenges, marking a new chapter in its storied history. The evolution of technology, the rise of global trade, and the financial crises of the modern era all tested the Fed's ability to fulfill its mission. With each crisis, its role as a central pillar of economic stability deepened, but so did the scrutiny it faced from policymakers, economists, and the public. The rise of digital currencies and technological innovation in the early 2000s witnessed an explosion in technology, and by the time the decade drew to a close, the world was being reshaped by the internet, mobile devices, and the rise of digital financial products. One of the most significant developments came in 2008 with the advent of Bitcoin, the first decentralized digital currency, created by the mysterious figure known as Satoshi Nakamoto. While Bitcoin itself didn't immediately challenge the US dollar or the banking system, it sparked a global conversation about the future of money, trust, and the role of central banks. The Federal Reserve, like other central banks around the world, began exploring the implications of cryptocurrencies and digital assets. As Bitcoin and other cryptocurrencies gained popularity, central banks faced pressure to consider how digital currencies might affect their monetary policies. In response, the Fed began to research and explore the possibilities of creating a central bank digital currency, CBDC, which could combine the benefits of digital technology with the security and oversight of a traditional currency system. The challenge for the Fed was clear. How could it maintain the stability and trust in the US dollar while embracing the future of digital payments? This growing conversation about digital currencies was also fueled by the rise of private companies like Facebook, which launched its ambitious project, Libra, later renamed Diem. The idea of a corporate-backed digital currency raised concerns about the potential for powerful tech companies to bypass traditional banking systems and central banks. The Fed, alongside other regulators, debated how to handle this growing trend, which posed risks to financial stability and sovereignty. Globalization and the Fed's international influence. As globalization accelerated, the actions of the Federal Reserve began to have far-reaching effects beyond U.S. borders. The U.S. dollar remained the world's dominant reserve currency, used in global trade, international reserves, and foreign investments. The Fed's decisions, especially around interest rates, had direct consequences on global markets, influencing everything from emerging economies to commodity prices. A change in U.S. monetary policy could trigger ripple effects across the world, affecting countries' economies in profound ways. For instance, in the years following the 2008 financial crisis, the Fed's quantitative easing programs not only impacted U.S. financial markets but also led to a surge in capital flows to emerging markets. While these investments helped fuel growth in developing countries, they also exposed vulnerabilities in economies that were heavily reliant on foreign investment. Some countries began to criticize the Fed's influence over their own financial systems, arguing that the U.S. central bank's policies could create instability in their local markets. The growing complexity of global trade also challenged the Fed to find ways to cooperate more closely with other central banks. Institutions like the European Central Bank, ECB, and the Bank of Japan, BOJ, collaborated with the Fed on monetary policy, particularly during times of economic crisis. For instance, during the 2008 financial crisis and the COVID-19 pandemic, the Fed worked alongside other major central banks to coordinate emergency lending programs and stabilize the global financial system. The Federal Reserve and the COVID-19 pandemic. In 2020, the world was struck by a global pandemic, the likes of which had not been seen in over a century. The COVID-19 crisis upended economies, forced governments into lockdowns, and created widespread economic uncertainty. The Fed's role during this period would again test its capacity to respond to unprecedented challenges. The central bank, under Chairman Jerome Powell, responded swiftly to the crisis. It slashed interest rates to near zero and launched new rounds of quantitative easing. The Fed also created several emergency lending programs to ensure the flow of credit to businesses, households, and local governments. One of the most notable steps taken by the Fed was its direct involvement in providing support to the U.S. Treasury, purchasing government debt to finance stimulus packages aimed at preventing a complete economic collapse. The Fed's actions during the pandemic were critical in maintaining the functioning of financial markets, supporting credit flow, and helping to prevent a deep recession. Yet, as the recovery began, critics emerged who questioned the long-term consequences of such aggressive intervention. The Fed's massive expansion of its balance sheet raised concerns about potential inflation and asset bubbles, particularly as the economy began to recover in 2021. At the same time, the pandemic also underscored the inequalities that existed within the U.S. economy. Unemployment surged, especially among low-wage workers and minorities, while stock markets and asset prices reached new heights. The Fed found itself facing the dual challenge of managing inflationary pressures while also addressing the needs of a labor market still reeling from the effects of the pandemic. Climate change and the Fed's new mandate in recent years, the Federal Reserve has also begun to confront an issue that was once outside its traditional remit: climate change. The rising threat of global warming and environmental catastrophes presented a new set of risks for the financial system. The Fed recognized that climate change could lead to financial instability, whether through physical risks, such as the destruction of property from natural disasters, or transition risks, such as the economic disruption caused by shifting toward a greener economy. In 2021, the Fed began to examine how climate-related risks could impact financial markets and began to incorporate climate risk into its broader financial stability assessments. This marked a shift toward considering environmental, social, and governance (ESG) factors in monetary policy and financial regulation. The Fed joined a growing number of central banks globally that were integrating climate risks into their frameworks for assessing financial stability. This development reflects how the Fed, over the course of more than a century, has expanded its focus from merely stabilizing the currency and economy to addressing broader, more complex issues that have global implications. The challenge for the Fed now is not just managing traditional financial risks but understanding how forces like climate change, inequality, and technological disruption will shape the future of the global economy. A future in flux. The story of the Federal Reserve continues to unfold as the world faces an increasingly complex and interconnected set of challenges. From the founding of the central bank in 1913 to the financial crises, the rise of digital currencies, the global pandemic, and the climate crisis, the Fed's journey has been one of adaptation, resilience, and transformation. The core principles of its mission, promoting economic stability, managing inflation, and ensuring a sound financial system, remain unchanged, but the way it fulfills these duties has evolved to meet the needs of a rapidly changing world. As we look to the future, the Federal Reserve will undoubtedly face new crises and opportunities, as economic, technological, and environmental forces continue to reshape the global landscape. The Federal Reserve's origins in the lessons of past financial instability will continue to guide its decisions, but its future will be shaped by the choices it makes in navigating a world that is more interconnected and more volatile than ever before. In the end, the Federal Reserve's story is not just one of banking and finance. It is a reflection of the ongoing quest to understand and manage the forces that shape our economy and our lives. And as the world changes, so too will the Fed, adapting once again to the challenges and opportunities that lie ahead.